Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
The trouble with having an open mind is that people will insist on coming along and trying to put things in it. Terry Pratchett, I am so clever that sometimes I don't understand a single word of what I am saying. Oscar Wilde, everything is funny as long as it's happening to somebody else. Will Rogers, the secret of staying young is to live honestly, eat slowly, and lie about your age. Lucille Ball, I like work, it fascinates me, I can sit and look at it for hours. Jerome K. Jerome.
Energy markets just found their pressure point. The Strait of Hormuz, barely 21 miles wide, moves roughly 21 million barrels a day, about a quarter of global seaborne oil and a third of LNG. With US-Israel strikes on Iran raising tensions, this narrow corridor suddenly looks like the world's most expensive bottleneck. If flows are disrupted, crude spikes first, inflation follows, and central bankers start sweating again. For importers, it's not geography, it's vulnerability. As Winston Churchill once said, safety and certainty in oil lies in variety and variety alone. Right now, variety looks limited. Here's the uncomfortable geometry. Within 300 to 800 kilometers sit Kuwait's oil fields, Saudi's eastern province, UAE terminals, Qatar's LNG hubs, and US bases, and the Strait of Hormuz itself. That's not a battlefield, that's the plumbing of global energy. You don't need missiles flying daily to move markets. You just need credible range and rising tension. Traders price risk before impact. Insurance premiums rise, tankers hesitate, and crude jumps. While one chipmaker commands a $4.5 trillion valuation, the entire mining industry sits at $1.6 trillion. That's not just a market gap, that's market mislocation with a hard hat on. Copper grades have fallen roughly 40% since the 1990s. Mines are older, permits take 15 to 19 years, and meanwhile, a 1 gigawatt AI data center uses up to 4 times the copper of a traditional one. Demand is exponential. Supply is geological. The US exports raw copper, imports it refined, and has just 3 smelters left. That's not efficiency, that's vulnerability. Look at that inflection. Before ChatGPT's steady growth, and after it, revenue goes vertical. Nvidia's quarterly sales are sprinting towards nearly $80 billion a year, a scale that most industrial giants took decades to reach. This isn't a cycle, it's a computer arms race. Every AI model, every data center, every tech giant is bidding for the same scarce chips. Margins expand because demand isn't polite, it's urgent. The market isn't valuing a chip company, it's valuing the toll booth on the AI highway. The mood music is shifting. PMI has cooled from peak highs, but remains in expansion. Not a slowdown, just normalization. Meanwhile, credit growth to industry and services is picking up. Translation sentiment is softer, but balance sheets are still borrowing. Services surplus continues cushioning the current account, even as non-oil deficits stay elevated. Capital flows volatile but not fleeing. Then there's the fiscal policy. The deficit is shrinking as growth moderates. That's pro-cyclical tightening, not stimulus. The market's old favorites, IT and FMCG, have slipped into the background. Their market cap is near historical lows, even though return on equity is still above long-term averages. Translation, earnings did not collapse, attention did. Post-COVID, money chased high-growth AI-linked stories. Defensive cash-generating sectors got derated. Now valuations are looking less demanding and fundamentals remain steady. When quality businesses trade at discounted relevance, that's not decay, that's rotation.